Hey everyone, it's Imran from Options Insight, your macro options spotlight for today. Now remember, before we jump in, please like, subscribe, comment to this video. So that really helps us with the algorithm and gets this content in front of more people. Anyway, so spot-wise, US stocks still pretty heavy. This program selling that seemed to be going on at the back end of last week seems to be continuing. And we think it might be these CTAs that are continuing to kind of reduce their exposure as we break down below certain key technical levels, and then momentum signals shift south. Now we've also got the S&P 30th of December 38.35 strike that I've been talking about. For those of you who've heard me, that's that JP Morgan put spread collar. It's the call option strike, which dealers are long, JP Morgan is short, and that thing is not expiring until the 30th of December. So that means dealers have got a load of gamma on that strike, and that may well be why the market seems to be gravitating towards that area and struggling to really break below 3,800. Because even though there seems to be a bit of bearishness in the market and some constant selling going on, the market still hasn't really managed to accelerate down through that 3,800 area. Now, if it was to do that, I think if we were to break 3750, then the gamma that is local to that strike kind of goes away, and the market may then accelerate. We might turn this into a real move going into year end, and it might be a similar setup to what we had in December 2018, where the market had a really bad Christmas. Okay, European stocks, dead cat bouncing, so not quite as weak. They actually had a small update yesterday. Obviously, they had a bit of a shocker last week on the hawkish ECB. So you can see here, you had Euro Stoxx, DAX, and FTSE all with small rallies yesterday, and then China staying relatively heavy as well. We have had Nikkei down 3% overnight on Bank of Japan action, which we'll talk a bit more about in a bit. If we look at FX, talk a bit more about this FX story. So the dollar did remain on the back foot yesterday, but we've seen a huge move in dollar yen overnight. Bank of Japan coming out and moving their yield curve cap from 25 basis points to 50 basis points. So you've seen a big move there, kind of spooked risk assets a little bit. We saw S&P down 1% in terms of the futures overnight, but it has managed to recover. So we'll see what the repercussions of that are. But a lot of macro commentators are out there saying this is a big deal, right? The Bank of Japan with their yield curve control policy was kind of underpinning bond markets globally and not letting yields move. And the fact that they've kind of let this cap move suggests they may be throwing in the towel, which means they're getting marginally more hawkish, and therefore that is a marginal tightening of financial conditions, which is probably not great for risk assets in general. Okay, bond markets were weak again. Yesterday we had TLT down 1.7% again, so a reasonable move lower, and that is again lower another percent overnight on the back of this move in yields in Japan, and that's filtering through to the rest of the bond market. So definitely something to keep an eye on. And like I say, it does seem like we're not getting a quiet week that we may have hoped for this week, given what's happened. And in terms of sectors, all the sectors were lower, even the energy sector, which has been trading quite well last few days and outperforming, that was down as well. But in general, those higher beta sectors getting hit, ARC down 3%, and metals and mining down 2.5%. Vol-wise, we are seeing a bounce in FX vol. Obviously, there was a bit of a bid to dollar yen vol going into that event. Understandably so. It was still great value. You could have bought that vol at 11 yesterday and you got a 3% move out of it. So anyone who bought gamma on dollar yen, well done. And then bond volatility softening, not massively, but kind of drifting slightly. It may catch a bit of a bid today, though, given what's going on. And it's definitely justifying the 20 level, right? We were looking for a bit of stability up there in TLT. We didn't think it was going to collapse quite as fast as it seems to be doing right now. So we thought vol would drift, but at the moment vol hanging in there around 20, and I'd say justifiably so. Okay, and the only thing to say on carry is that we are still seeing quite a bit of negative carry in FX, which is kind of, unless that turns around soon, FX vol are going to keep going up. They've already started to bounce off their local lows, but we are seeing some pretty negative carry here across the space in FX vol again, because those absolute levels of FX vol just seem to be easy to trade around right now, given the macro landscape. Okay, that's it for the summary. So we're talking about Japan. That's kind of the most topical really thing going on. So have they thrown in the towel, right? So we had them shifting the rate to 50 bips from 25. They've said that that is not a shift in yield curve control policy, but markets have taken it as a sign that the policy may likely be ending when Kuroda's term ends in April next year. So dollar yen obviously down 3% from where it was 137.5 down to 132. So that's a big move there. You can see the chart on dollar yen here. So doing some serious damage on the technicals, getting below its 200-day moving average. We also saw yield spiking. So the 10-year JGB popping from 25 bips. It was just sitting there at the cap and it's gone up about 20 basis points. So obviously that's probably going to work its way up to the next cap, which is 50. And that's, there's not a lot they can really say or do about that. Markets are kind of going to take them on. Like I said, initially risk assets did sell off. Nikkei was down 3%. S&P was down 1%. It does seem to be recovering a little bit. It's chopping around, but for now, risk assets don't seem overly concerned. Although if you kind of step back and think about it, that is a big marginal tightening. And it does suggest that pivots from the likes of the Fed are even less likely if that's what's going on, basically. Okay. Now, interestingly, precious metals and crypto have caught a bid on the news, right? And that's somewhat counterintuitive. If this is a marginal tightening of financial conditions, I wouldn't have expected crypto. I mean, you may get this safe haven bid that comes to gold, alongside yen. If yen's popping, maybe gold has some correlation to that sometimes. But the fact that crypto's up, I think that feels a bit weird and a bit wrong. And I'd probably be fading that if I was going to tactically trade anything right now. Stock futures, like I said, have traded back up a bit, but today's session is going to be important. If stock futures finish down on today's session and they, like I say, they get away from that key sort of 3,800 area, then we could be in for a bit of a traumatic end to the year, basically, in risk assets. Okay, so what else are we looking at? So I've been having a look at high yield versus TLT. So in recent weeks, obviously we've been flagging that the market focus has been shifting towards growth concerns next year rather than inflation. The inflation data does clearly seem to have peaked. Treasury bonds have been outperforming stocks, and they've also been outperforming high yield bonds as risk-free returns look attractive if a recession is coming, right? Given where yields have got to, especially a recession where the Fed may be slow to pivot, unlike previous. Now, looking back at the last growth shock that we had, if we go back to March 2020, we can see here the divergence in performance that you get from the likes of TLT, which is a treasury bond, to the likes of HYG, which is high yield. Okay, so whilst they can kind of move in unison with each other, there or thereabouts, they don't have that strong a correlation, but they can kind of do similar things because they're interest rate products. When you do get a big growth shock, you see this massive move up in TLT and you see this massive shock down in HYG as risk assets get killed, credit spreads widen out, treasury yields fall, basically, right? So that's what can happen when the market really gets fearful about growth rolling over. Okay. Now, if we assume that this is a type of price action that we can expect once a recession really starts to be priced in, and that's likely at some point, let's say, in the first half of next year. If people are thinking the recession starts maybe middle to end of next year, markets usually price it in early. So we should expect to see the stress in markets occur a bit before that. So now I'm not saying we're going to see necessarily the same magnitude of moves where TLT is up 20% and HYG is down 20%. I mean, that was an extreme growth shock that we haven't seen in 100 years, right? So I'm not expecting that. But to see, TLT up 5 and HYG down 5, that doesn't seem ludicrous. And that's the kind of move that I think could easily happen as we start to price in a recession. So how can we play that in options? For listening, guys, like I said, it's going to be a little bit more interesting this week than I thought it was. And we'll catch you all tomorrow. Cheers.